So without further waste of time, we'll be going into the business of today. So we'll be taking the topic on understanding financial management and securities markets. So the person who will be taking us on that course is none other than Ridwan Olajide. He is a financial audit and advisory officer. Ladies and gentlemen, with a clapping of hands, please can we welcome our trainer for today in the person of Ridwan. Ridwan, if you can hear me, please take it up from here.
All right. Good morning, everyone. Thank you, Mercy, for the sweet introduction. And I welcome everybody to this morning session. Uh, my name is Ridwan Olajide, as rightly mentioned. I am a financial internal audit and advisory officer. And the topic we'll be discussing this morning is understanding financial management and security market. All right. And I want to quickly put this out here this morning. Let me use this medium to welcome Kingsley, Olusegun, Richmond, Gatti, John, and Beauty. I welcome you all to this morning session, and I believe it's going to be an interactive class. You are feel free to use the chat box to state any question. And if I'm moving too fast, please kindly let me know. If you have any comment or reservation, please kindly put it there in the chat box. However, intermittently, we'll be allowed to use our mic to give comments and at the same time, interact with the class. So permit me to share my screen so that we can both view the class material together. All right, before we continue, please kindly confirm that you can hear me.
Loud and clear.
Please, can we hear me?
Yes, loud and clear.
All right, thank you very much. So good morning once again. Can we all see my screen now? Please confirm if you can see my screen.
We can see your screen.
All right, thank you. All right. So this morning we are going to cover role of finance and financial manager, how organizations use funds, obtaining short-term finances, raising long-term financing, equity financing, security markets, buying and selling at security exchange markets, trends in financial management. Okay. If you've been following the business masterclass for about 2 weeks, you'd realize that we've been discussing financial reports, presentation of financial reports. I think 2 weeks ago, Osila Maester took the topic of financial reporting and what it entails. So this morning we'll briefly be, tapping some of the contents of that particular class to further buttress our points here and to ensure that we have full understanding of the terminologies we are going to be using in this class. All right, so the role of finance and the financial manager. The finance is the science of managing a firm's money so that it can meet its goals. Financial management is critical because nearly all the business decisions have financial implications. Okay? So for every organization, definitely needs what we call finance department to be able to run smoothly and effectively. and a finance manager is saddled with responsibility of managing the affairs of the organization financial wise. So whatever money that comes to the organization and how the money that comes to the organization are expended is managed by the financial manager. So it is the core responsibility of the financial manager to ensure that the monies generated or being invested in the business is properly managed in order to have an effective financial decision and also to avoid any negative financial implication that might be exposed to the business. So the financial manager is responsible for developing and implementing the firm's financial plan, as well as identifying the best sources and uses of funds. So what is financial planning? It is the forecasting the short and long-term financial needs. Okay, so when we are talking about financial planning, we are simply talking about budgeting. All right. So all organizations have their expectations, and in terms of revenue, they have expectation as to how much money we are going to make within a particular period, as well as how much money are we to spend or to commit in order to be able to match this expected revenue. All right. We are also going to explain investing the funds. How does an organization get funds to invest? Then how do we allocate this capital to assets and projects that will generate the best returns for the organization? Financing the firm, identifying and securing the optimal mix of debt and equity to fund operation and growth. So overall, what we are trying to say now is that these three key elements, financial planning, investing the funds of the organization, and also financing the firm, is the sole the decision here is the sole responsibility of the finance manager. The financial manager overreaching goals is to maximize the value of the firm for its owners while balancing risk and return. So in summary, what we are trying to say this morning is that in every organization, the optimum results or the goal, the overreaching goal of a finance manager is to ensure that the finance that is available for an organization or a business to use is used maximally to uh, increase the value of the firm and also balance the risk and return of that investment. All right. I'm moving to the next slide, talking about the financial manager key responsibilities. Just like we have said earlier, in discharging his duty as a financial planner, investing of funds, and also financing the firm, what does a financial manager needs to put in place? The number one thing on the bullet point is that the financial manager must have a financial plan and budget. This gives a clear view of where the organization is headed financially. Without a clear plan, there won't be a template, so to speak, to follow in order to achieve the organization goal. The financial manager must also monitor cash flow and liquidity. I want to make reference to the class held by Osilama Esther. In the component of financial statements, she mentioned the balance sheet, the statement of comprehensive income, which is generally known as statement of profit or loss, and also the cash flow statement. All right, so what does cash flow statement lists out for the financial user. All right, this gives you the detail of the inflow and outflow of cash into the organization. All right, and at every point, a financial manager must always maintain a positive cash flow in order to make the company liquid enough to meet its financial obligation. So the number two point on the list is monitor cash flow and liquidity. Evaluate capital investment opportunity. Determine the best financial mix or financing mix, which is the debt versus equity. I'm going to fully explain what we mean by financing mix. Manage relationship with banks and investors. Ensure compliance with financial regulations. All right. So your finance person or your finance manager in your organization must see to these bullet points to ensure that the company is not at any point in a financial risk. Okay, so manage relationship with banks, ensure that the bank is working effectively, have access to the funds as at when needed, be able to negotiate terms with the bank and also the investors. At the same time, ensure compliance with financial regulations. So I'll use Nigeria as a case study. We have financial regulations from the CBN. We have financial regulation from the NRS, the formerly known as FIRS. So these regulations must be adhered to, and the person that is saddled with that responsibility is the financial manager. Why do we even need financial management at all? Without a sound financial management, the profit of a company can fail. A profitable company can fail. A firm may earn strong revenue, yet still run out of cash if receivables are not collected promptly, if expenses are poorly timed. So let me further buttress on this point. Let's take a scenario of a company that makes a monthly revenue of about 50 million naira, for instance. And the salary budget for the month is around 4 million naira. What we expect is that for a company or a business that does 50 million naira revenue, shouldn't find it difficult to pay salary of 4 million. Am I right? Please, I want to confirm that we are following. Can anybody just react to what I've just said? A company that generates 50 million naira revenue monthly, should it have any difficulty to meet its salary budget of 4 million? Hello, are we there?
Please take that again.
A company that generates 50 million naira revenue on a monthly basis, all right, and has a salary expense budget of 4 million, should that company face any challenge to be able to meet expenditure of 4 million naira salary?
No, sir, not at all. I don't
All
think
right,
so.
good. Let me tell you that this can actually happen if receivables are not properly managed, if expenses are poorly timed. And I'll explain this to you fairly.
I have a
A
question.
company that, okay, you have a question?
Yes.
Okay,
My
let me hear from you.
to the question you just asked us with regards to a company that make a monthly revenue of 50
What did you
million.
say?
My question is, related to the question you just asked with regards to a company that make a monthly revenue of 50 million naira, and if it should have difficulty paying a salary of 4 million naira,
Yes, ordinarily.
Yes. So I'm
Should that be the case? Should there be any difficulty for a company that generates revenue to meet its salary expense?
or 4 million naira?
Ordinary 4 million naira.
So I think this will have to be if the whole 50 million naira is put to is the 50 million naira the, what do you call it now, the entire working capital, or it has to do with what do you call it now, there are some other part of the balance sheet that is inclusive in this 50 million naira.
Yes, your point is valid. All right. So right now, the scenario I'm trying to like pitch right now is uh, a ordinary scenario where the revenue generated has already made, let's assume we have about 20% profit margin on the revenue. So with that, I think it's fairly enough to say that we have enough profit to accommodate that expense. All right. So I just want to use this to buttress my point of saying that if cash is not properly managed, that is, whatever we sell to our customers are not received in cash, the cash for that process, for that from that sale are not received, or the expense are poorly timed, the case may occur where the company or the business might find it difficult to meet its salary expense.
How possible
All
is
right.
it to relate this with the cash basis and accrual basis of accounting?
So I'm explaining this now based on accrual basis because mostly we are, for private organizations, they are allowed to use accrual basis to prepare their accounting reports. So for accrual basis of accounting, it allows that you recognize your receivables when the performance obligations is already met. Okay, so you've already fulfilled your performance obligation. You have sent out your product or your goods to your customer. Your customer has received it and already acknowledged your invoice. Okay, so under the accrual basis of accounting, you are expected to, recognize that receivables. Okay, so I'm pitching a scenario right now that the company is depending on what it actually generates as income for the month to be able to, meet its financial needs. All right. So
Thank you very
as
much.
as a businessman, I feel that if you can make up to a 50 million naira revenue that already embedded 20% profit margin, you shouldn't have a difficulty to meet such an expenses if you properly plan your expense and also you ensure that receivables are collected as at when due. So the fact that you make 50 million naira in revenue doesn't uh, automatically translates to the fact that you'll be able to meet your expense if you do not properly manage your finances. So your cash flow statement is really, really important, and how you ensure that cash flows into the organization is really, really important as well for the financial manager to be able to meet its operational obligation. All right. So does that answer your question, Mr. Yusuf? And I
Yes,
hope we are all clear with this point.
yes, please. It does. Thank you very much.
All right, thank you very much. That means we are following. So I will be going to the next slide, explaining how organizations use funds. How do we use funds as an organization? Once a firm secures capital, the financial manager must deploy it wisely. Funds are used for two broad categories of expenditure: the short-term needs, we call it operational needs, and the long-term investment, which is the capital or capital assets, or use it for further investment to be able to grow the company. All right. So let me explain what short-term expenditure means. All right. These are typically the operation costs, including the salaries, inventory purchases, utilities, your account payables. All of this must be funded within 1 year. All right. So let's take another scenario now to further explain this. It is a new company. All right. This new company wants to venture into soap making. Okay. And for soap making, definitely you need to get some materials to be able to produce your soap. At the same time, you need to get some machineries to process those materials in order to have your output. So if the investor, let me say the business owner, has 5 million naira to invest or to drop down as capital, all right, the financial manager must be able to give a list of assets needed to be able to process the materials, and at the same time give a budget for materials needed, and then the salary costs for the workers that are going to be working in the factory, and at the same time other expenditures like that. So in that scenario, the financial manager must allocate costs to satisfy salary, to purchase inventory, to pay for utilities. At the same time, must also allocate from that capital the cost of property, plant, and equipment, that is the machinery you are going to use for the production of that of your output. Also, maybe for acquiring your factory, and so on and so forth. Okay, so if there are any excess of this money, then you can invest it in something that brings growth into your organization, such as research and development, such as acquisition, such as gaining entry into new markets, and other strategic initiatives. Okay, do we understand how the money or how funds are used in an organization now? You can just give me a reaction in the chat box if you understand how organization uses funds. Just give a thumbs up in the chat box. Okay. While I believe we understand that, we are moving to how cash flows through a business. All right. A business owner can bring in capital, which is the owner's investment. You can also borrow money to run business, which are called borrowed funds. You can sell your assets to raise funds in order to meet operational needs. When you collect money from your receivables, that is people that you sell to on credit, when they pay you, money flows into the organization. If you sell and you collect cash immediately, or they pay into your bank account immediately, that is money going into the business. And how does money goes out of the business? You pay expenses, salaries, rent, electricity, telephone expense, and other expenses that may be applicable to your business. Purchase of inventory. For inventory-based organization, if you be needing material to be processed before you get output to sell to customers, you need to purchase inventory, you need to purchase materials, you need to pay dividends. If you have shareholders, you also need to purchase fixed assets. So that is how cash flows out of the organization. All right. So before I move to this next slide, I will just pick randomly. Adiola, can you tell me one of the ways money comes into the organization? You can unmute and then tell me, how does money moves into the organization? How does funds move into the organization? Adiola, are you there? Hello.
Yeah, good morning.
Yeah, good morning. So I just want to ensure
Though,
that we are all following. So how does money
what happened?
flows through
What
a
happened?
business? How do we generate
What
money
happened
into
is
a business?
what happened is I just joined now, and I was busy, so I just joined.
All
So
right,
I'm
that's fine.
sorry. I missed some parts. So
All right, that's fine. I'll just take it over again. How cash
okay,
flows through a business? Owners' investment. When they pump in capital into a business, that is money going to the business to be used for
okay,
business
okay,
activities, uh, uh, their operational needs or capital investment needs. Then, when you borrow money from institutions like banks in order to fund your business, that is cash coming into your business. Although it comes at a cost, however, it doesn't deny the fact that money is coming into your business. Sales of fixed assets can also bring in money to you, collection of account receivables, and you collecting cash immediately after selling. This is how money comes into an organization. All right. And how do we understand how money goes? The money must be for expenses, must be for purchase of inventory, can be for the payment of dividends, and can be for the payment of interest and the likes. Any expenditure or any financial obligation that is expended uh, in the course of doing business, these are how money flows out of a business. Let me quickly chip this in. This cycle that you can see on my screen, this is how financial ombudsmen, okay, uh, investigate how a business is being run to be able to ensure that the business is not laundering money, okay? If there is any money that comes into your business that is not an owner's investment, that is not a borrowed fund, you did not sell anything to bring in the money, then the money is questionable. Okay? It is expected that monies must come into your business for the purpose of business, and there must be some documentation to back that. So if there is any money that is traced to your account and does not have any history of business, anything, so the financial regulation institution can term that as money laundering or fraud. Okay, so having explained that, let's move to managing short-term expenditures. All right. So this is a very critical responsibility of a financial manager. All right, because this is where the financial manager skills of management comes into play. Because the financial manager must ensure that the company or the business must not run out of money to be able to meet its financial obligations, whether it is a short-term financial obligation or a long-term financial obligation. A financial manager or a finance manager must ensure that money is always available to meet any type of business oriented expenses. All right. So day-to-day financial management focuses on ensuring the firm has adequate working capital. What do we mean by working capital? The working capital is, let me just explain this in a layman language, okay? Your cost of current assets, all right, and your cost of current liability. So the total amount that you are expending in your current asset, because when you remember when Esther was explaining to us, I don't know how many of us joined the class that was held 2 weeks ago by Yosilama Esther. All right, she explained one of the components of balance sheet, and where we under balance sheet we have the fixed assets, which is the non-current asset, and we have the current asset. The element under current assets is your cash and cash equivalent. We have your receivables, and we have your inventory. And also under the liability side, we have the short-term liabilities, such as the amount you have to pay to your creditors, such as the amount of overdraft, and so on and so forth. So this is what I mean when I'm talking about working capital. Your working capital is these are the elements in your current assets and your current liabilities. Okay, so what does cash management mean? Cash management firms must maintain enough cash to meet obligation without holding excess idle funds. All right. Uh, the first part is there must be enough cash to meet obligations. At the same time, there must not be excess idle funds sitting down somewhere without yielding any interest or bringing returns. What I mean by this is that, for instance, in the month of May, or let me say between January and June, your finance manager already projected that between these 6 months of operation, the company is expected to generate a cash inflow of 50 million. And the financial obligation for this period of 6 months is 25 million. Automatically, what this means is that the other 25 million will be sitting in your bank account. All right. If it is not judicially or prudently used, it will just be there without returning any value. So the finance manager must ensure that any idle cash must be put to use in order to bring a return to the company, whether you invest it in an interest yielding investment, or you invest it in something that brings growth to the organization, growth that can be measured financial wise. Okay, ultimately avoiding that there shouldn't be any time within this period of 6 months, that there will be a shortage of cash. You must ensure that there is enough cash to meet your financial obligation, and at the same time, the idle cash that is sitting in your bank account must be put to use in order to be able to bring return. So to speak, you must maintain a balance between available funds and your investment, okay, such that it doesn't affect meeting your financial obligation. All right. So having explained that, account receivable management, this is purely speaking to how you uh, assess, evaluate, and also make decision on your receivable policies, your credit policies. What causes receivables in the first place is your credit sales, because in every business you might encounter some of your customers being loyal to you, or as a result of any credit worthiness reasons, you give them that opportunity to take your product or to take your service with the intention of paying later. So your credit sales is what brings about your account receivable in the first place. Ordinarily, if you do not make any sales on credit, there is no reason for you to track any receivable account. Okay? But the moment you sell on credit, then you must be able to manage your account receivable in such a manner that the stipulated period or the time that you are supposed to receive the money does not exceed, the customer does not exceed that period before paying. They might not get up to that period before they pay, but you must ensure that you do everything possible for them to pay within the stipulated time. this is going to be a factor that will determine how cash flows into your organization, because already in the budget that you prepare in order to effectively manage your cash, you are already expecting that this money will come in within this period of 6 months. Any mistake or any reason at all for that money not to come in at the expected period, it means that it's going to negatively impact your cash flow or your cash management, because the money that you are expecting to expend on a budgeted expenditure did not come in. You understand? So that is the reason why you must ensure you manage your account receivable such that the monies your customers owe to your business comes in as at when due. Financial manager balance these trade-offs to optimize cash flow, just like I've explained. Then the last one is the inventory management. All right. The inventory management is talking about holding too much inventory ties up capital. This is telling us that a financial manager must be able to give an account of inventory that we must hold in order to meet the expected output that will bring the expected revenue. What do I mean? If a financial manager has already budgeted that we want to make 20 million naira this month, okay? In order to make this 20 million naira this month, we must produce 50,000 units of our product, all right? Now, the material to be used or to be processed in order to produce this 50,000 units of our product is 25,000. It is reasonable that you must have in store 25 units of that material to produce 50,000 units that will give you 20 million naira revenue. You see how it works? Okay? Holding anything short of 25,000 unit of material, okay, will impact the revenue that you are expected to make. And at the same time, if you invest too much buying excess material, tying it down, okay, this will also impact your cash flow, because the money that you are supposed to use to, meet other financial obligations, you've already used it to, buy or tie down capital. Okay? So a financial manager must ensure that at every given point or at every given level, you have inventory that is enough to reach your output goals for that period and also reach your revenue expectation for the month. All right. So any up to this point before we move to obtaining credit facility, short-term financing? Is there any question? Is there any question up to this moment? All right. So thank you very much. I think I will move to obtaining short-term financing. All right. When a firm's cash outflow temporarily exceeds the inflow, it must obtain short-term financing. Funds needed for 1 year or less. So remember earlier when I was explaining working capital, there's something we call working capital management, or let me say working capital cycle. All right. So these are your short-term current assets and current liabilities. So it is expected at every given level that you must maintain a positive balance between current assets or current liability. That is, as an manager, you must ensure that your current asset is able to finance liability. That is, must be a positive balance. Let me use a numerical data to explain what I mean. The total of your current asset is 20,000. It is expected that your current liability should be less. Okay, because it is your short-term financial obligation. All right. Whatever makes your short-term financial obligation higher than your short-term asset you are expecting, or cash that is your current asset, it means that there is a cash deficit. So if this situation arises, the finance officer must be able to pay a short-term finance to augment for that difference. All right. Funds needed for 1 year or less. There are two primary categories. They are secured, no collateral required, and secured backed by assets. All right. So if let me give you an instance. All right. For instance, there is a need for for cash to be able to your current asset and current liability. You now take an overdraft from the bank. The bank is giving you an overdraft on the basis of probably maybe your performance, your turnover in your bank account, and they are giving that fee for an interest. All right, it is not backed by any collateral. Submit any asset document to be able to obtain that loan. So that is what we mean by unsecured short-term finance. But by the time you submitting documents for you to be able to obtain loan, so that type of financing is called secured financing. So unsecured short-term finance, trade credit. If you have good people, for the example I was earlier, making Indomie, you want to buy material from, all right, and you do not have enough money. So for them to be able to give you this credit, it's unsecured short-term finance is an example. Commercial credit agreement. These examples of unsecured short-term financing. Unsecured short-term finance, using your account receivable as collateral, that you want to receive this so money this loan. So what you borrow me this, you can collect this from the people that are owing me too. So we call that debt factoring. Inventory loans.
Hello.
Network is
Hello,
bad,
sir.
Using
sir.
your inventory as
Your
Hello,
network is
sir.
what did you
bad,
say?
sir. I
Yeah,
say it's
please.
cracky. Your network is
Can't hear
bad.
that.
Yeah.
Hello.
Your network is not stable, so we are unable to hear all the explanation you are giving, sir.
Okay, can you hear me now? Is the network okay? Is it better?
No, it's not better, sir.
Hello, is the network now?
No, it's still not better.
Oh, this is serious.
We are sorry about that. We don't have control over the network. Mr. Ridwan, maybe you can restart your device and then get back. Thank you.
Okay, can you hear me now?
Yeah, it's better now.
Yeah, it's better.
It's better now, right?
Yeah.
Okay. Can anyone in the audience please let me know if it's better, if you can hear me?
Oh, it's okay. It's okay now. Let's see how it goes.
All
It's
right.
clear.
So
It's audible.
can you just tell me where the network started acting up? What was the last thing you heard from me? So that I know where to take off from. Do we all understand what I mean by short-term expenditure, managing short-term expenditures, the cash management, account receivable, and inventory management?
You can start from unsecured.
Okay. All right. That's fine.
Yep.
So I was explaining unsecured loan. So let me just use a layman explanation for this. Whatever loan you get, when we mean short term in finance, what we mean is that if you are taking this loan, you must be able to settle the loan within 1 year. So anything short term is within 1 year. Whatever you need to do, any activity regarding that particular loan or assets, it is within a period of 1 year. So obtaining short-term financing, there are two categories. It can be unsecured and it can be secured. Whatever financing you are getting that you are not using collateral as a requirement before you get that financing, it is unsecured. All right. And I gave example of having overdraft from bank, taking bank loans, all right, without any collateral, trading credit. These are examples of unsecured short-term financing. Secured is just the direct opposite. If you are using your assets document as a collateral to be able to get financing or finance, it means it is secured. So in the advent of you not being able to pay, the person can actually trade off your collateral to get their money. So that's what it means basically. All right. And the example under that is using your account receivable as collateral, factoring your debts, and then inventory loans too. So that's an example of secured loan. I hope we are following up to this point.
Yes, sir.
All right. You can just give me a
Yes.
reaction in the chat box if at all we are following. All right.
Okay, sir. Can I ask a very simple question?
All right, please go ahead.
Okay, so for the unsecured and the secured uh, term of financing, what what will be the advantage and the disadvantage of the two if in terms of a company is not able to service its loan on time?
Well, I would say it's scenario based. All right. I will give you a typical example in Nigeria, right? So if we are to take any short-term financing, short-term facility, all right, it's always limited in amount. That is, there is a limitation to the amount you can collect under the STF, that is the short-term facility, short-term financing. There is a limit to what you can take. However, if it is under secured financing, the limit is is different. For instance, a bank might tell you that their overdraft for you is 5 million. Okay. But if you are able to back your facility up with a secure document, they might increase it to about 15 million. All right. So it's just a matter of risk evaluation from the bank side. All right. They might feel okay, given the criteria, probably maybe the number of turnover you do, the amount of money that comes in and goes out of of your bank account. After doing their risk assessment and evaluation, they feel you are worthy to be given 5 million naira short-term advance. That's the level of guarantee that they can place on your business. So in some cases, what your business might need at that point might be more than that 5 million. So you won't have any other choice than to, either uh, tender your documents to be able to secure higher loans. So in terms of which one is better, it's scenario based and is depending on the amount needed by the finance manager to be able to save the company at that point. All right. But ordinarily, unsecured means you are not dropping any documents, even if at the end of the period that you were given by the bank to pay up, you were unable to pay up. It is only your interest that will be accruing. Okay. But if you are securing with a document, by the time you default and notification is being sent forth, you still do not turn up, what they do is that they trade off your security deposit. Do you understand?
Please, yes, it's very clear. Thank you.
All right. So moving on to trade credit. Trade credit arises when a supplier allows a buyer to purchase a good and pay for them later, typically 30, 60, or 90 days. It is essentially an interest-free loan from the supplier. So that is why you have it here as one of the example of unsecured short-term financing. So this one is interest-free, okay? So you are able to get goods from your supplier without paying them for the next 30, 60, or 90 days without adding any interest. Suppliers often offer a cash discount at times for you to be able to pay up. In fact, they will be the ones to even tell you, if you can pay between now and 15 days, we'll give you 20% off of what you owe in the business. All right. So what is the advantage of this? There is no formal application of process, flexible and automatic, no collateral required. The disadvantage is that it's costly if discounts are missed. Okay. Strains supplier relationship if overused. Limited by supplier credit policy. Okay. So sometimes if you constantly do not pay up what you owe a supplier, it reduces their confidence in your business. So it further declines your opportunity to get a future trade credit. That's one of the disadvantages if you overuse that privilege. Then it is costly if you miss discounts. All right. So uh, moving on to raising long-term financing. All right. So raising long-term financing funds capital expenditure and strategic growth initiatives. Assets and projects with lives extending beyond 1 year. So anything we are calling long-term in finance, it is beyond 1 year. I explained earlier, short-term is within 1 year, but long-term is beyond 1 year. So firm choose between debt financing, that is borrowing, and equity financing. If you look at what we are discussing from scratch, what we are trying to achieve with this class is understanding the financial management, just like we have said, and then the security market. All right. So if you have a business as a business owner, at what point do you need any of these two? That is, do you need to finance your business with debt financing, or you need to finance your business with equity financing? Debt financing just means that you are borrowing money, okay? But equity financing means that your control over your company, you are selling part of it. Sometimes you can also do combination of both, okay? Sometimes you can do combination of both. I quickly want to share another screen with us. But, okay. So asset capital needs. This determines the amount and duration of funding required for the investment. Then number two is that you evaluate financing options. These are the things that you look at before deciding on what
The slide,
type of
sir,
financing.
the slide is not showing what you're saying. Oh. The slide is not showing what you're saying.
Okay. Can you see my screen now?
Yes, we can see your screen.
Hello.
Davis or Security.
Okay, good.
It's
All right.
showing short term too,
It's showing what?
while you're talking about long term. It's showing trade credit, the common short term too.
This is where I am, raising long-term financing.
And it's not showing on my screen. Oh. I
I'm
don't
seeing
see
raising
any.
long-term financing.
Yes, please. Probably maybe you need
Restart
to.
your system.
Yeah, this is where I am. I'm raising long-term financing is what I'm explaining currently. So if you are not here, probably
I
maybe
can
you
see
need to
raising
like
long-term.
restart the system or leave there or join the system
Yeah, I
early.
cannot see it. Oh.
Yeah, you can just leave and join the meeting after. Like just leave and join the
Okay.
meeting immediately again. So you get this. All right.
Okay, thank you.
All right. Yeah. So raising long-term financing. These are the things, these points 1 to 4, you look at these steps and then decide on what type of financing does your business need. Like I said, you can choose between debt financing, which is borrowing, equity financing, selling part of your business. If, for instance, the business is owned by one person, okay, the moment your business take up equity financing, it means that you are no longer the sole owner of that business. There is a co-ownership between you and the person that take up equity from your business for an amount. Sometimes you can do a combination of both. All right. So asset capital needs. Assess capital needs. So you first need to assess what you need the money for. Determine the amount. Determine the duration of the funding required for the investment. All right. For instance, if my business, I want to like take it up from generating 50 million naira revenue in a year to be able to be generating 200 million naira a year. So the finance manager look critically into the situation and look at, okay, fine, if we are to do this, definitely we need to increase our revenue up to, if we have been producing 50,000 units before, to be able to move from 50 million naira revenue to 200 million naira revenue, that means we need to be producing 200,000 units. All right. And in order to produce 200,000 units, you will be needing additional material, we'll be needing additional assets, that is machinery, to further, increase the output of the business or the organization. So the finance manager assess that, look at the amount it costs. Okay, Gatti is raising his hand. All right, Gatti, you have the floor. You have a question?
Please, yes, a very quick one. If I'm on the same page with you with your explanation regarding the equity financing, that is bringing in.
I
Uh,
can.
can you hear me?
Yes, I can hear you now.
Okay, I'm saying that if I am on the same page with you, based on the explanation that you gave about the equity financing, if a company adopts that, it means that a new investor is coming in, isn't it? Good. So if that's the point, would that change the company structure? That
Yes,
is
definitely. Yes, definitely. It has to,
okay.
you know,
Okay.
change the company structure because a new owner is coming in.
Okay.
Typically, what that entails is that if you are taking up a new owner, a new co-owner, okay, you value your company before the person pump in money. So there is what we call pre-money valuation and post-money valuation. Okay, if your pre-money valuation is 50 million, that is your total stake in the business. Okay, And the
Okay.
additional money that this person is bringing to be able to set up growth for your company is that person's quotient of your business. For instance, if the capital required, I'm explaining assessing capital needs now, the amount needed, let's assume is 30 million, and your pre-money valuation is 50 million, which forms your total stakes in the business. All right. Your 50 million pre-money valuation, by the time the person pumps in 30 million, the post-money valuation of that business is now 80 million. All right. Which means you as the first owner owns 50 million of the business, and the person that just come in owns 30 million. So that has automatically changed the structure of the business. Do you understand?
Okay. Okay. Right.
All right,
Okay.
thank
Thank
you.
you. Right.
So now we move to evaluate financing options. You compare costs, risks, and flexibility of the debt versus equity sources. All right. So in order to make a decision of what type of financing, long-term financing you need, whether debt financing, equity financing, or the combination of both, the finance person must also compare what is the cost, because the cost of borrowing is interest. Do you agree with me? Hello?
Yes, we do.
All right. Then
Yeah.
the cost of equity, all right, is selling part of your business, which
Perfect.
is, yes, which is dividend. That is, you'll be sharing whatever the outcome of the business is at the end of the year. All right. Sometimes you can do a combination of both. You borrow small, you sell part of your business small, okay, to maintain a balance. So maintaining that balance is where we have what we call selecting the optimal mix. An effective finance manager must be able to choose effectively the capital structure that minimizes costs while preserving financial flexibility. All right. Then you'll be able to access capital markets. Okay. If you are not doing a private equity that you want to, trade, you want to trade your shares in the capital market, just like most of the banks did earlier this year, like the likes of Dangote, like the likes of, other businesses trying to take, public offers. All right. So you sell equity through public or private market in order to raise funds. All right. So up until this moment, do we understand what we mean?
Yes, sir, I understand.
All right. Thank you very much. So debt versus equity, choosing the right mix. Just like I said earlier, you should be able to know what is the cost of borrowing, what is the cost of equity. Let's look at debt financing and equity financing side by side. Debt financing includes bank loan, bonds, and mortgages. Interest payments are tax deductible. Ownership and control are not diluted. Remember I said that if you took up a loan from a bank, all right, you are not sharing your ownership. You only have to pay the principal plus the interest at the end of the facility term. Okay? Increase financial risk. Financial risk can be increased if there is too much debt, and this can lead to insolvency. So you must, be able to project that whatever money you are borrowing is going to positively impact your business such that you move from point A to point B with the newly introduced funds into your business. That is, if you are making 50 million naira before, with the newly introduced fund used effectively in your business, it should move you from 50 million naira revenue to 80 million naira revenue, thereby increasing your profits at the end of the day. Okay. But by the time you are taking up money, you are borrowing money, and there is no really, change as to what your bottom line is. Okay? At the end of the day, you are still making a loss. It's accumulation of debt. All right. So it can actually lead to insolvency. Then it is best when the firm has stable, predictable cash flow. That is, debt financing is best when the firm has a stable, predictable cash flow. What we mean is that if you budgeted that you are going to make 50 million naira this month, it's either you surpass that budget or you are exact. Anything falls short of what you have budgeted, okay, it makes the firm unpredictable and the revenue unstable. So borrowing might lead to accumulation of debt in this kind of scenario. And also your expenditure. You must streamline your expenditure such that it meets at par or falls short of your budget in order to achieve a favorable bottom line. All right? So let's go to equity financing. Equity financing includes retained earnings and stock issuance. So sometimes whatever, for instance, let me explain retained earnings. What retained earnings simply means is that you traded last year and your bottom line is a positive. That is, you made a profit of about 20 million. So that is seated in your account. But this year, you realize that you've been doing business for the fourth quarter of the year, you are making a loss of about 10 million. So this equity financing is increasing the amount of, that retained earning, the money that you are bringing from last year is what you are using to finance this year operational activities. Okay, so that's retained earnings. And then stock issuance means that you are selling off your stock. That is your equity, rather. There is no mandatory repayment obligations, although there are different types of stock options. If you um, you are taking up an equity financing from an individual or from a corporate organization, but they are telling you that maybe after controlling 20% of your business for the next 5 years, you have the option to buy back your stock. Okay, that means that you have repayment obligation, but it is not mandatory unless it is stated in the term sheet, your agreement sheet. All right. Then you dilute existing ownership and control. That is, if you are the sole owner before, immediately you have equity financing. What that means is that you are no longer the sole owner of that business. Dividends are not tax deductible. It reduces financial risk. No fixed interest burden, as in comparison with debt financing. That one is tilted towards paying interest to whichever institution you got the loan from. But for equity, the person is bringing their money in for a quotient or a fraction of your shares. Then it is best when the firm needs flexibility or has uncertain cash flow, whereby your revenue is unstable, your expenditures are unstable. Then the best option for you is equity financing. Sometimes some firms might use a combination of both, okay, to optimize cost of capital while managing financial risk. Major differences between debt and equity. We have under debt financing, the creditor does not have a say in your business, okay, unless the borrower defaults payment. All right, but under normal circumstances, if you are to pay as a when due, your creditor does not have a say in your business. But once under equity financing, once you hello, can you hear me?
Please, can you try to increase this page a bit because it looks very small?
Hello, can you hear me?
We can hear you.
All
We
right.
can hear you.
So,
Can hear you.
yeah. Can you
All right.
increase this page a bit?
Okay.
Yeah.
Sorry, it doesn't permit me to increase more than this.
You have to zoom in to see it well.
So I think if you are using your phone to join the class, it's going to be small because at my end here is very visible.
I'm using my laptop.
Oh,
Wow. Probably maybe you just have to like increase the screen, the size of the screen. You can just enlarge the screen. Make it a screen. Okay. All right. So can we move on, please?
Yes, we can move on. We can move on.
All right.
Yeah. Thank you.
Decisions in the business without employed. Have a right to income and assets. Debt holders under debt financing rank ahead of equity holders. That is, in the advent of probably maybe the business is folding up, or you are trying to sell your business to another person, the uh, the your creditors, they have a rank ahead of equity. That is, you must first settle what you owe before the shareholders can take what is left. So that's what that means. Equity owners have residual claim on income. That is, dividends are paid only after paying interest and any scheduled principal, just like I've explained. Then maturity date, when debt needs to be paid back. Debt has a stated maturity date under debt financing. It's your term sheet, that is your agreement, facility agreement, it is there. But under equity, the company is not required to repay equity, which has no maturity date. All right. Like I said, sometimes there might be maturity date. It depends on what is in the term sheet, what is in the agreement between you and the new shareholder. If they want to hold the shares for period of time, let's say 5 years, and they give you options of buying back your shares at the end of 5 years, then you can repay. All right. Then tax treatment. Interest is a tax deductible expense. That is, in your financial report, you can deduct your interest expense before calculating your accessible profits to tax, right? Then dividends are not tax deductible. All right. So up to this point, is there any question? Hello? Hello?
Not at the moment, sir.
All right.
Thank you.
So can we quickly take a small quiz? So in the chat box, I want to quickly ask a question. All right. How many types of long-term financing can a company choose from? Hello?
Hello, sir.
Yes, in the chat box.
Okay.
Tell me, how many types of long-term financing can a company choose from?
How do you say? How many type of what?
Long-term financing can
Long.
a company choose from? Okay, Humphrey is saying two types. Okay, Kati is saying 2 types. Okay. All right. Can somebody mention 1 type for me?
Long-term loan.
Long-term loan. No, that's not the word I'm actually looking for. All right.
Yes,
So,
loan
Humphrey,
capital.
do you want to try?
Yes, loan capital debit.
Okay.
Uh,
I think you got the logic. You got the logic actually. So we
Ye-
have the debt financing and equity financing. Okay.
Oh,
So
yes,
the debt financing is when you borrow, then the equity
yes.
financing is when you
This, yeah,
uh
is where you borrow money that must be repaid over a long period of time.
yes. Thank you. Thank you. All right. So I think we'll move on to our next what's it called on the slide. All right, let me stop sharing for a bit. I think I'm having issues. Okay, let me share my screen again. All right, I'm sharing PowerPoint. All right, I'm sharing this. Thank you. All right, that brings us to the end of the first session. So,
Okay.
and thankfully, we all understand what the role of finance manager is and how this finance manager can help us or help a business determine when it needs funding and the type of funding that is best suitable for the business as at when due. All right. So it's been a fruitful time, but we'll be moving on to equity financing and securities market. All right. Are we ready? Are we ready?
Yes,
Yes,
sir.
sir. We're ready.
All right, great. Thank you for following. What is the role of equity financing? When business need long-term capital, they turn to equity financing, that is raising money by selling ownership of the shares in the company. Unlike debt financing where you have to borrow, equity does not require repayment of principal or guaranteed interest payment. Okay? Equity financing is especially important for corporations seeking large amount of capital for expansion, research, or major investment. Okay? So remember when I was explaining the short-term and long-term financing, somebody asked a question and I said it is scenario based and it is depending on the amount needed by that organization to save a face at that point. Okay, so if the amount that is needed is, relatively low and below what the business is worth, okay, you can decide to use short-term financing like taking up an overdraft or a short-term loan or trading your trading credit with your supplier. All right. So, but if you are faced with a decision or a challenge of diversifying, major investments, going into research and development that requires large amount of capital, what most businesses does is to take up a long-term financing, most especially the equity financing, because it doesn't, have a required repayment period and it doesn't require you to pay back interest. Okay? Types of equity. There's what we call common versus preferred. We have common stock. You can also refer this stock to as your shares. All right. Your shares is the fraction of the stake in your business. That is, if anybody is bringing in money to invest in your business, they are taking up a fraction of that business. It can be either called stock, just like what is traded in the public market or your security exchange market, all right? Or popularly referred to as shares, all right? So the most basic form of corporate ownership is common stockholder have voting rights, typically 1 vote per share, to elect the board of directors and decide major corporate issues. They may receive dividends, but only after preferred shareholders or stockholders are paid. What is preferred stock? Preferred shareholders or preferred uh, stockholders generally do not have voting rights, but they receive a preferential treatment in 2 key ways. They receive dividends before common stockholders, and they have higher claim on company assets in the event of liquidation. All right? Don't forget, I said these two stocks can be referred to as common shares or ordinary shares. And the preferred stock can also be referred to as preference shares. I think many of us in Nigeria here we can relate with preference shares and ordinary shares or common shares. I don't know what it's called in Ghana. Can somebody help me and tell me what this type of stock is called in Ghana? Gatti, can you help me? Hello?
Yes, sir. Not
What is
not on top
preferred
of my
stock? Huh?
not on top of my mind, but
I
let me
can't
search.
hear you.
I'm saying that not at the top of my mind, but I can search it for you, sir.
Okay, that's all right. But it's
Okay.
popularly known as preference shares here. And the difference between these two shareholders is that while the preferred stock or the preference shareholders receive their dividend first before the ordinary shareholders, and they also have higher claims on company assets in the event of liquidation. That is, if a business is facing liquidation as we speak, by the time we are trading off the assets to settle off its liability, the preferred stock owners are settled first, and the residual value goes to the common stock owners. All right. I haven't explained that. I think
Okay,
uh
I'm back.
yeah.
Okay,
So
so under the Companies Act,
it's all right. It's all right. We can we
okay,
can move ahead. So
okay,
going public. What do we mean by going public with your shares? Going public means that you want the general public to, subscribe to your shares. That is, you need funding. So if a business feels that they want to move rapidly or exponentially big, okay, they are seeing potentials of their business. That is what the business can do, the performance of the business, how it can transform from making, let's say, 1 billion naira revenue to about 10 billion naira revenue. They are seeing the opportunities. They know that if they can invest enough in the business, this business has the potential to grow from a billion naira revenue to 10 billion naira revenue. Looking at this opportunity inside, they need funds to ensure that they take the opportunity to the maximum level and generate the maximum return that they can get from the market. So they go public. The initial public offer, this occurs when a corporation sells its stock to the general public. For the first time, it conducts an initial public offering. This process transforms a private company into a publicly traded one and is one of the most significant financial events in a company's life. All right? So the IPO process is complex and heavily regulated. Company must file detailed registration statements with the Securities and Exchange Commission and work with investment banks that underwrites the offering, agreeing to purchase shares at a set price and resell them to the public. So this is changing the whole structure of an organization. A privately owned organization, that is, probably maybe it is owned by one person or two persons initially. And because of the opportunity that they have in sight, they want to go public. They want to generate more funds to be able to fund their operation and grow their business from 1 billion naira revenue to 10 billion naira revenue. They are going public, and it is stated that this IPO process is a complex and heavily regulated process. You need to register with the Securities and Exchange Commission in the country and then work with investment banks to underwrite the offering for you, agreeing to purchase the shares at a set price and resell them to the public. What are security markets? This is the market where stocks are traded. All right. I know Ghana has its own security and exchange market. Nigeria has its own security and exchange market. The US has security and exchange market. All right. So the primary market is where new securities are sold. All right. We have two types of market: primary market and secondary market. The primary market is where new securities are sold for the first time, including your IPOs. The proceeds go directly to the issuing corporation. Investment banks play a central role as underwriters, buying the security from the issuer and reselling them to the investors. The secondary market, this happens after the initial sale. Securities are traded among investors. Let me just explain this in a way we can all understand. Let's assume I am Mr. Ben, okay? And my company ABC is going public for the first time. Then Mr. John is buying my shares for the first time. This type of transaction happens in the primary market. But in the event where Mr. John, who purchased Mr. Ben's stock, okay, wants to now, convert his shares to money, wants to trade off his shares. That is, he's now selling the shares of XYZ Limited that he purchased from primary market. The market that is going to sell their shares is the secondary market. That is, this is where the existing investor sell their shares to another intending investor. Okay, the already purchased shares that I have acquired, I want to sell it to another investor. So this type of transaction takes place in the secondary market. Do we understand? Please, do we understand?
Yes, sir. Very clear.
All right, great.
Yes, sir.
So how stock is bought and sold? Investor buys shares or securities through brokers. These stockbrokers are licensed professionals who execute trades on behalf of the client. That is, you as an individual, you cannot just go to SEC market as if it's your local market where you buy food stuff. No, you need to go through a purchase your shares. You need to open a brokerage account. You place an order. Your order is executed, and then you have the settlement. That is, the trades typically settle within 2 business days when ownership officially transferred and payment clears. All right. So that is the process of buying and selling shares. Then reading the stock market performance. Bull versus bear market. A bull market is prolonged period of rising stock prices. typically associated with investor optimism and strong economic growth. A bear market is a sustained decline of 20% or more from recent highs, often reflecting economic contractions or widespread pessimism. All right. So a bull market, this is a market where rising stock prices typically associated with investor optimism. Okay, have been traded. That is, if there a prospect that a particular share or a company shares is going to rise later, maybe in like 2 months, okay, you realize that so many people will be interested in buying that particular shares because they know that the value of that share or that stock is going to increase in the next 2 months. That is, if you purchase 5 million naira worth of stocks, it means that in the end, by 2 months' time, okay, your shares would have increased from 5 million naira in value to about 7 to 8 million naira in value. But a bear market is where you are trading off your shares because you know that that particular 5 million shares is going to be reduced in value. All right. So that is the bull versus bear market. Then some corporations choose between equity stock and debt financing based on cost, risk, and strategic goals, just like I explained earlier. Understanding the trade-off is essential for financial managers. All right. Under common stock, and we are comparing common stock and bond now. Repayment required. Sometimes, okay, let me state this. Sometimes, okay, the financial manager chooses between equity and bonds. What is bonds and what is stock? I think I explained stock earlier. All right. Stock is when stock is purchased or when a particular company trades its stock, it means that you are selling a fraction of your business to another person or another institution or organization. But when you trade bonds, what that means is that whoever purchased your company's bond has a commercial paper, has a security deposit with your business. That means you are also borrowing that money from that person, but it is secured. You are giving the person a commercial paper that can be traded. Okay. However, this bond can be traded at maturity. For instance, if you purchase a bond worth 5 million naira, okay, at maturity, you would have agreed the percentage of increase on that value of 5 million. By the end of the maturity period, the owner of that bond can come back and trade off the bond. Okay. But the difference between that is that there is no exchange of, what's it called? Dividend. All right. The interest and dividend under common stock, the dividend is optional. But under bond, you have to pay interest on the commercial paper. Voting rights. Under common stock, whoever has a fraction of your business have the right to every major decision in the business. But whoever owns a bond does not have a right to decision. Risk to issuer. All right. There are lower risk to issuer under common stock because there is no fixed obligation. However, if you are trading bonds, there are higher risk. The tax treatment, okay, the dividend is not tax deductible. I've explained this earlier, but interest is tax deductible. Claim on assets. Okay, like I said, the ordinary equity holders, the common shareholders, they are last resort. After everybody is settled, all creditors are settled. That is the residue is what is being shared to the common stock owners or holders. There is priority over stockholders under the uh, bond issuance. Who regulates the security market? The security market is regulated by Securities and Exchange Commission. Okay, in the US, this is primary federal agency overseeing the US security market. Its mission is to protect investors, maintain fair and efficient market, and facilitate capital formation. Full disclosure of material information in prospectus. These are the requirements before you can even trade your shares. Regular financial reporting. Prohibition of insider trading. What is insider trading? Buying or selling of security based on material non-public information. Okay? For instance, if I am an investor and I want to purchase XYZ Limited shares, ordinarily, because I am an outsider, I don't know whether the business is going to flourish or not. But the moment I have a prediction or I have an insight from somebody working inside the organization that, wait, this company is going to skyrocket from 1 billion naira valuation to 10 billion naira valuation, I know that there's a positive prospect with this business because of that single information. Okay, and because of that, what have I done? I've used that information to influence my decision, it actually defeats the fairness that the SEC is trying to, uphold. All right, it means that other parties that are willing to buy the shares outside, they do not have the same information that you have. As a result of that information, if you are willing to buy just 5,000 units of shares before, you increase it to 10,000 because you already have a positive insight from somebody inside the organization that this particular shares is going to multiply in value. However, if you are holding 5,000 shares and somebody tells you from the inside of that organization that this company is declining in value, you quickly want to go and sell your shares so that it doesn't reduce in value. So the SEC is frankly against insider trading. Okay, so that is what insider trading means. So the key takeaways from this financing and equity market is equity financing and security market is that we have two types of stock. We have common stock. We have primary and secondary stock. The IPOs, this is when a company is going public for the first time, and then the regulation protects investors, which is the SEC. They enforce disclosure, prohibits insider trading, and ensures markets remain fair and transparent and efficient. So I think this is the end of equity financing and security market. Please, let's take, this is 11:47. Let's take 10 minutes break and then we reconvene at exactly 12 p.m. But before that, is there any question as regards equity and finance and security markets? Equity financing and security markets. Hello? Hello, are we here?
Yes, sir.
All right. Is there any question before we go for break?
I have no question, sir.
Okay, what's the question, please?
I said I don't have questions, sir.
Okay, Humphrey, thank you.
Thank you, sir.
Okay, so
Ani Baba,
I have one question for you.
Titilayo, John, Gatti.
Yes,
Any question before we leave for break?
please, yes, I have one simple question for you.
All right.
So, which of the approaches that an owner of a company is likely to lose all of its shares? Because it has happened in recent times somewhere in the US where, because the company is not doing well and they were doing equity financing, and people came and bought majority of the shares. So it actually took that veto power from the original owner. So which of the approaches that applies here? I hope my question is clear.
Really, it was actually skipping. I didn't get the full question. Please,
Okay,
can you
so,
repeat the question?
so I am asking which of the approaches that a company or an owner loses all the
Skipping
shares.
again.
Oh, then maybe it will be the network.
Yes, it is. Okay,
Oh,
can you just type the question in the chat box? Then hopefully I will address it when we come back from break.
okay, thank you, sir. Thank you.
All right, thank you. So Mercy, are you here?
Yes, I'm here.
All right, so please can we take just 10 minutes recess and we'll come back by 12 p.m.
Okay, so if we come back, we are rounding up the class with that, right?
Yes, I think I want to just briefly explain the securities market, and then from there we wrap up the class.
Okay, thank
That's
you.
very okay. All right, everyone, let's just take a 10-minute break and we'll be convening back at 12 p.m. Please do not go too far. Thank you.
Okay.
afternoon, my fellow professional colleagues, and I hope we've been enjoying the class that we have today. Before we went for our recess, we discussed the role of a finance manager, and then we also discussed equity financing and then security markets. Okay, so I believe Mr. Gatti had a question earlier, and I think I would want him to come up with the question again so that we can I can answer it and then move on to what we have now. Mr. Gatti, are you there? Hello, Mr. Gatti, are you there? Oh, okay. All right. I hope he sees this. Maybe he's not with us yet. He will come back to us. All right. So can we all still see the screen? Please kindly confirm if you can see the screen. Hello. All right.
Screen.
All right, great. So security markets, understanding financial management and security markets. I think we explained what security markets are earlier, what we trade in the security market, and we have two types of markets, primary market and secondary market. Can somebody remind me what we trade in the primary market? Osareme, were you here? Humphrey, were you here? What do we trade under security primary market? What kind of shares do we trade under the primary market? Hello.
Issuance of IPOs.
Hello, I can't hear you.
The primary market is where companies issue their IPOs for the first time. Please, can you hear me?
I can hear you now.
Yeah, I'm saying that the primary market is where companies issue their IPOs for the first time.
Thank you very much for the first time. So if you are selling your shares or you are making your company public for the first time, then your shares will be traded under the primary market. However, the secondary market, if there is an existing shareholder or existing stockholder who wants to trade off his shares, then to another shareholder, to another investor. So that kind of transaction takes place in the secondary market. Okay, so the major security exchanges, we have the New York Stock Exchange, we have the NASDAQ, we have the global exchanges. In Nigeria, we have Nigerian Exchange Commission, we have the Nigerian Security Exchange Commission. So in Ghana, Mr. Gatti, can you assist us? What's the name of your exchange market?
It's the Ghana Stock Exchange.
In Nigeria, we have Nigerian Stock Exchange market.
Yes, we have Ghana Stock Exchange.
All right, thank you.
You're welcome.
So how securities are traded, I think we've said this earlier. The investor goes through the broker. The broker helps to execute the trade, and the confirmation is sent. All right. I've explained the bull market and the bear market earlier as well. Can somebody remind me what the bull market is? So this is more like a recap of what we have done. All right. Can somebody tell us what the bull market is and the bear market? All right. To save our time, the bull market is when the buyer, okay, keeps buying because of the rising stock prices. All right. And the bear market is when there is an economic contraction, thereby leading to the reduction in the value of the shares and investors are selling. Okay, that is the bear market. Reading the stock quotation, we have the high and low, we have the dividend and yield, we have a percentage ratio, price to earning ratio rather, and we also have volume. So the highest and lowest prices at which the stock is traded over the past year, this is what we call the high and low. So this gives signals volatility and trend. Okay, so when you are using your high and low method to make decision on what stock to buy based on the past event, at what point did this stock reach its highest performing price, and at what point was it traded for its lowest price. So this information is useful for an investor, and it gives signals of volatility and the trend of that particular stock. Dividend and yield, annual dividend per share and yield as a percentage of the stock price. Okay, these are key for income investors. Okay, so whoever wants to invest will be looking at how much will I be having on this my investment as a dividend. Okay, this is something you need to look at. Then price to earning ratio, this compares stock price to earnings per share. All right, and then volume, number of shares traded in a day. High volume can confirm price trends or signal major new events. Right. So regulation of security markets, all right. Disclosure requirements. So the SEC requires that you disclose your financial reports. And insider trading laws. I know I said earlier that the SEC prohibits insider trading. Exchange oversight regulates the NYSE and NASDAQ. Investor protection ensures what? Fair trading practices. All right. So buying and selling of security exchanges. Full services versus discount brokers. Full services provide investment advice, research, and personalized service. That is, as an individual that doesn't have any knowledge at all as to what stock to buy, but there is funds to invest in stock. So you engage the service of what full service broker to give you investment advice, give you some research materials and personalized service, but they collect higher commission. Okay, discount brokers, this execute trade at lower cost with minimal advice, ideal for self-directed investors. For instance, if I'm motivated, I want to buy GT Bank's share. Okay, I don't really need, because I've determined what share to buy. I don't need the service of a full service broker. I just go to the discount broker direct and execute the trades. Okay, so the what's it called? The cost is generally lower. Then online brokers, these are web-based platforms offering low cost of commission, free trades. This is now dominant in retail investments. Okay, trends in financial management and security markets. The algorithmic and high frequency trading. A computer-driven strategies execute thousands of trades per second, increasing market efficiency but raising volatility concerns. Globalization of markets. Investors can now trade on exchanges worldwide, increasing diversification opportunities and cross-border capital flows. So Nigeria experienced this globalization of markets, and during the early 2011, there is what we call venture capitalism. Does anybody have an idea of what that means? Do we have an idea of what venture capital means? Okay, so now the
Yeah.
venture capital, these people.
Hello?
Hello, I can hear you, Humphrey.
Yeah,
Venture
I
capital,
wanted to
do you
attempt.
have idea?
Yeah, venture capital specialize in investing on investment, investing on they have portfolios, they invest on
Okay.
companies, or companies wants
All
to
right, that's
take you
that's
for.
that's that's good. That's good. Okay, so mainly what venture capitalists do is that they look at investment opportunities, they look at prospects in your business, and they feel like, okay, if this business can, they see the prospect, they see the future. Okay, if you people can actually be, that's what we are talking about, trends. Okay, they look at your highs and lows over the, a particular period, and they feel like there is a future in this industry for this business to grow, then they put in their money. In Nigeria, we experienced, the emergence of VC around 2010 to 2018. But during the COVID period, 2019 to 2022, everybody was at home, sitting down and thinking about businesses that's going to yield money. That's like a realization year for everyone. So this brings new, freshly baked ideas that are pitched to investors, and it actually allows foreign investors to invest in local uh, businesses, even ideas. Because the emergence of this tech actually, it it uh, started having its rapid growth around 2019 to 2022. And, this recent time, 2023 to 2025, but to date, is the recent correction and stabilization stage. So what venture capitalists do is that they see a prospect in a business or ideas, and then they invest in it. Okay, so this does not just doesn't have any regional limitations. So global markets comes into, markets or industries or regions like Africa to invest their money due to globalization of markets. There is increased regulation. Okay, because of internet, the algorithmic and high frequency trading, there is need for strict regulation in order to ensure fair trading and at the same time secure the funds of investors. So what are our key takeaways? All right. We know we have the primary versus secondary markets, just like we have explained, the investor protection, the evolving landscape due to technology, globalization, and tighter regulations. So I think that is the end of our presentation. Okay, so to fully recap what we have learned today, we have learned the finance and financing. We have learned the role of a financial manager. We have also learned the long-term financing, short-term financing. We've learned how businesses get funding, okay, and how they choose the type of funding that best suits their situation at the moment, or at the present, as the need may be. Yeah, as the need may be. Then we also learned about the security market. We learned about the types of market. We learned about the type of securities that are being traded in each market. And lastly, we also talked about the function of the SEC and what they do to investors protection at large. So that brings us to the close of the presentation, and it's time for question and answer. So please just raise your hand if you have question, and then we will answer your question. Hello, are we there? Okay, Gatti is raising his hand. Please.
Okay.
Yeah.
Thank you for a very detailed presentation and how you've been able to break down all the issues. When it comes to raising capital, I would like you to share your thoughts on whether a firm should go to the traditional banks for money or go to the open market. Um, which one is the best option, and based on which criteria should a firm take that decision? Thank you.
All right. This question is, I think I've explained earlier. All right. However, I will still buttress my point that the first step towards determining what type of funding and who to seek this fund from is to first evaluate what is needed. What is the goal? What do I want to achieve? What do I need to achieve this? You need to translate all of these reasons, these hows, into financial data. That is, you need to know in specifics how much do I need to venture into this business or to invest in this business to further expand our growth. Okay? That information from the finance department or finance manager, most small businesses, okay, doesn't have the capacity to, engage the service of a finance person or a finance manager, which means the owner of the business, let's take a one-man business, for instance, is also the finance manager because you are making the decision by yourself alone. Okay, so that is why this knowledge is very, very useful for anybody who is into one business or the other or owns a particular business. Okay, so you need to know how much is needed. If you know that you've done your calculation, you've done your financial projection, that your business is going towards 50 million naira in the next 6 months, okay, then you need to put in the work. What is going to take me from 0 to 50 million? If I get this so money, what do I, expend it on? How much is going for capital expenditure? How much is going for operational activities? Okay, these put together, all right, will make you determine how much is needed. Then the decision of how much is needed will further clear your mind who to approach or what type of financing is suitable for your situation. All right. If you are an existing business that just needs to survive for a short period of time, for instance, you notice that probably the business is down for a while. You have been doing 500 million naira in the first instance. Okay, and you have financial obligation for the next quarter, You've projected that you are going to be doing in the first quarter, you are doing 1.5 billion. Okay. And at the end of the day, the second month into the quarter, you are making 200 million revenue. Automatically, your cost, your short-term expenses, you are unable to meet them. You are unable to meet them. So this situation is different from somebody who wants to invest in a new idea entirely. This person just need the money for a short period just to, spring up activities back and then be back at their feet. So this type of scenario, you only need a short-term financing. You can get that through a loan. You can also get that through trade credit. Okay, that is scenario one. For somebody who wants to further invest in his business, increase the capacity of what the business output is. All right. What the person needs to do is to evaluate what you need to get you from point A to point B. Like I explained earlier, if you are a billionaire worth company earlier and you want to transform that billionaire company to 10 billionaire company, you need to have your projected sales. That is where this money is going to come from. You need to have your projected expenditure. Both these metrics are what is going to form your decision towards getting the amount needed for that investment. Okay, and you know that moving from 1 billion to 10 billion is not something that's going to happen overnight. So this particular scenario is a long-term scenario. So to speak, a long-term investment, a long-term financing is suitable for this type of scenario. So do you get the point, Mr. Gatti? Hello, are you there?
Please, yes, I'm here.
Yeah, do you get the point?
Please, yes.
Yes, so everything as to this is emanating or originating from your financial data, which is prepared by either the person responsible for finance. Let me put it that way. Because some companies might not have a finance manager. But whoever is saddled with responsibility of finance should have a detailed, information as to what will take the company from point A to point B and what the financial obligation requires. So this will help you make an informed decision on what type of investment to be adopted. Thank you.
You're welcome.
Does that answer your question?
Please, yes, it does. Thank you so much.
Mr. Gatti?
Please, yes, it does.
All right, thank you very much. All right. Any
Yes.
other question before we wrap up the class? Ayomikun, who's here? John, Princess, Humphrey. Any other question? All right. So I presume we have a very interesting class.
Hello, sir.
Okay, Humphrey, I can
Hello,
hear
sir.
you.
Yeah, thank you very much for this interesting class. They're really interesting and it's eye-opener for us in business. But I have a little one question, just one question. How can companies assess the capital market and also exit?
I think I lost you. Mr. Humphrey, I can't hear you.
Okay, let me come again. So my question is this. I want you to explain to me how companies can assess the capital market if they want funding.
Access what?
And if capital market.
Capital market.
To buy stock. Yes,
to buy
yes.
stock. Okay.
Yes.
Like I formally
yes.
explained.
Or sell their stock. Or sell their stock. Then also if they want to exit, how can they exit?
All right. So originally you just have to go through a broker. All right.
Okay.
And we have full service broker, and we have the on duty broker, because the full service will give you, for somebody who doesn't have idea of what stock is but has money to invest, you engage the service of a full service broker. Okay, this person gives you advice. Okay, these are the list of stocks that we have. Okay, due to his analysis and advice, okay, this one is best performing. This one has tendency to perform. Let's take MTN, GTB, Stanbic IBTC, for instance. So he's telling you GTB is at its peak performance presently, but in the next 6 months, there is a tendency that this stock is going to drop in value by 20%. However, Stanbic IBTC is experiencing a creeping time right now. So the value is not really good, but it has a prospect to rise above 50% in value in the next 6 months. You have another one that's, is only a fraction increase. Okay, so it will give you all of these scenarios and you have to choose from it. All right.
Okay.
Then the other person, this one doesn't give you advice at all. Although the full service, the implication is that one charges you more. All right.
More.
The other broker, this one, you already have an informed decision of the stock to buy. You just want somebody to help you buy. So you as an individual cannot just walk into the SEC. You have to go through a broker. And if you can just Google, there are so many brokers around. Right? So you find a suitable broker, they take your order, they take your investments, they help you negotiate, they buy, and in 2 working days, you are the owner. And the same goes to if you want to sell. They help you find a buyer that wants to buy, and then you exchange values. That's all.
Okay. Okay. Thank you, sir.
Yes. Any other question? Okay. All right. So thank you very much, everybody. Mercy, that's my time.
Thank you so much, Read One. Thank you. Everybody, let's give a round of applause to him. And today we happen to finish off the class quite early. Please, a round of applause to our trainer. Thank you, Read One. It was a beautiful session. Okay, so just a few announcements before we call it a day. So regarding your test, please, anything regarding tests will be sent to you all on the platform. And then the material used for today's class will be sent, as well as the link to the recording. If there is any other announcement, you always hear from us in the platform. So like I said before we started today, if you want to graduate with the people who already started this program in first semester, please do well to adhere to the information that was sent, I think, 3 days ago. So we are already creating a group for that, so it will be easy for you. And materials for first semester has been sent to that group. And we are going to also schedule you for tests and exams so you can meet up, right? I believe this is understood. And then for some of us that are still complaining about payment of their registration fee, I want to believe that Paystack, you can use Paystack to access other country, right? So I think that should be sorted. With Paystack, you can send your money to us. That would be more easier. I believe that is understood. Please follow us on all of our social media handles, as I always say, Facebook, Instagram, Twitter, LinkedIn, and subscribe to our YouTube channel. Any other information will be sent across to you all. Thank you so much for standing by. And from
Merci.
here, I would say, have a
Hello, Merci.
question.
Yes,
Yes.
a quick clarification. I actually raised my hand.